An asset is basically anything that can be traded for a currency or something else that's worth money. So we can talk about our home. Our home is an asset. I can sell my house and turn it into cash and then take that cash and buy gold, or I can buy a car, or I can buy a rental property. I can buy something else that's worth something that's an asset.
Hello, everybody. This is Jake Stenziano, host of Wheelbarrow Profits Podcast, here with my co-host, a multifamily mentor, the coach and chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, this is going to be a challenging one for me, bro. Thank God we've got an amazing guest. That's all I got to say, Jake.
No technology issues stopping us today. So today's guest is Jay Scott, an entrepreneur, investor, and co-host of the BiggerPockets Business Podcast. In the past 10 years, Jay and his wife have bought, built, rehabbed, sold, lent on, and held over $50 million in property all around the country. Woo! Jay runs the popular website 123flip.com and is the author of 4 books on real estate investing, including the best-selling book, The Book on Flipping Houses. So without further ado, Jay, welcome to the show.
Thanks, guys. Thrilled to be here.
You got a lot going on there. So for the folks that don't know you, give us a little bit on your investing background and tell us what you've been working on recently.
Yeah, so I started investing seriously back in 2008. My wife and I left the tech world, the corporate world, when we started a family and wanted to have kids because we were working too hard, honestly. I mean, we were working 100 hours a week. She was traveling 3.5 weeks a month. I was traveling a couple weeks a month. And it's just not the type of lifestyle conducive to starting a family. So when we decided to get married and start a family, we left the corporate world and we said, let's do something else. And we kind of fell into real estate. And so for the last 12 years, I guess, we've been investing in all aspects of real estate. In that time, we've kind of branched out a little bit. I've written a few books on real estate. I've done some investing in other asset classes. We can talk about that. But basically, it was a lifestyle choice. We decided to get into investing just so that we could focus on family first, and then still make money doing it, but kind of make our own rules and our own work-life balance with our investing. So yeah, that was the reason we got into it. And in the last 12 years, we've done a whole lot of real estate, a whole lot of other things, and it's been a great ride.
So, Jay, for us at Jake and Gino, we like to say we create multifamily entrepreneurs because we learned, not early on, about 3 or 4 years into our career, that multifamily wasn't just an asset to you're buying, and it's just one. You're buying multiple businesses. Every little deal is a business. When did you realize that in yours? Because I know in 2008 you started flipping homes at probably the worst time ever. You could buy the deals, but nobody was buying them from you. So when did you see early on that, wow, I'm an investor. I'm not just buying a building here or a house here?
So yeah, I mean, it's funny because we did our first house flip, and I guess I got best known for flipping houses because I wrote a lot about that. And we were flipping a lot of houses for a bunch of years, but I don't think of myself as a house flipper, even though a lot of other people do. I think of myself as kind of a holistic investor. I like different asset classes. I like different investing models. I mean, we talk about flipping houses. Flipping houses is in some respects investing, but in other respects, it's more a business. It's more transactional. Flipping houses isn't passive. It's not something that you kind of set it, forget it, and you make money for the rest of your life. But it's certainly a style of investing, which is a lot different than other styles of investing. I mean, if you hold rental houses, that can be a lot more passive. If you hold multifamily, as your listeners know, that can be passive. You can hold multifamily and do it passively, or it can be very active. If you do syndications, if you do value add multifamily, where you buy it and you renovate it and then you resell it, that can be somewhat active. That can be very active if you're on the operator side of that. Then there's things like lending. Lending is kind of half and half. I mean, there's a lot of active work that goes into lending. You have to do your due diligence. A deal doesn't go on forever, but then once the loan is made, you get cash flow for a couple of years. So there's a lot of different types of investing and investing styles, investing strategies, investing niches within real estate. And what I like to say is that depending on your resources, depending on your experience, depending on your goals, and even depending on what you enjoy doing, that's going to kind of lead you down one or more of those paths. And so for me, flipping was the right way to start. We just kind of fell into our first flip. It was something we did because my wife was watching HGTV and said, hey, let's go flip a house. Like we were like taking the summer off, waiting for our wedding to come up and trying to decide what we were going to do next. And we just decided to flip a house just for something fun to do. And that led to the second and the third and the 50th and the 100th. And suddenly we're house flippers. But a couple years in, I realized, okay, this is great. We're making like piles of cash on each flip. Each flip, we're making $15,000 or $20,000 or $30,000, which is awesome. But then we also realized that, well, the day we stop flipping houses, those piles of cash stop. And now we might have a bunch of cash sitting around, but that cash isn't making us any money and we're not making any additional money. And that's when I realized, okay, I need to take these piles of cash and I need to invest them in something that's going to continue to return us cash.
Yes.
I forget who said it. I think it was one of the Shark Tank hosts that said something like, you have to think of your I think it was Mr. Wonderful who said, you have to think of your cash as like little soldiers. You send them out, they fight a battle and they come back with captives, other little soldiers, other cash.
I guarantee it. He has the best quotes, that guy.
Yeah, it's great. I don't remember exactly how he said it, but it was perfect. You send them out, they fight, they come back with more. And that's really what rentals were. And so that's when, like back in 2012, I said, okay, I really got to start getting into rentals. And then we started doing some lending, and then we started to do some multifamily, and then we started to do, and literally it's been a 12-year journey. And it was just about 3 months ago, we picked up our first syndication deal. So even after 12 years, we're still branching into new areas because, again, what is it that you want to do? What is it that's going to help you hit your goals? What is it that you're good at? What is it that you have the resources for? And it took 12 years for me to get to the point where I said, syndication is now the thing that I'm ready for. And so I jumped into that. And that's the nice thing with either real estate investing or investing in general, is that no matter what you're good at, what you enjoy doing, what you have the resources and time and money to do, there's always a strategy out there that's going to make sense for you. It's not like there's only one thing to do and it's not a square peg in a round hole. I mean, no matter who you are, there's something in real estate that's going to suit your style, your goals, your experience, and what you enjoy.
I need to reiterate that again. Everyone write this down. What are your goals? Number one. Number two, what are your joys? What do you like to do? If you hate house flipping and you hate fixing stuff and you're starting out, that may not be the place you need to start, because you may not start and you may stop right away. Number three, more importantly, what are your resources? Resources, not just of time, of treasure, of time also, because when I started my resources, I was in the restaurant, in the kitchen. I couldn't go house flip because I didn't have the time to do that. So I bought a fourplex and I got into it, quote unquote, passively, because you can deal with the smaller multifamily and have another job. And I think Jake did the same thing. We bought a 25 unit together while he's out, driving around selling legal pharmaceuticals, selling legal drugs. That's what we could do. That was our resources. So it's time and treasure. And I love Jay's story about the inflection points, different inflection points in his life, starting out in single family and then flipping and then going to different businesses. What I want to do, Jay, is I love your posts on in Facebook, because you blow everything up. You make it controversial without making it controversial. And what really caught my eye the other day was, what is an asset? The biggest thing is you ask the question and there's 3,000 different answers. Is your home an asset? Answer that question for me on here, because for me it is, but it isn't, right? It's like my home is a money pit. I know Jake's home is an absolute money pit.
We don't want to go there.
It's an asset for our life.
It's a luxury.
Style choice. It's a luxury. But let's define for any investor out there. Let's learn that word, an asset and a liability. Let's define that for everybody.
Yeah. So first we have to take a step back and realize that anytime you're going to use a term like asset liability, it shouldn't be a charged word. It shouldn't be something that causes
I'm triggered, Jay. You're not woke enough for me, bro.
Everything's charged nowadays, isn't it? People just want to fight. We just want to fight, right?
It's crazy. It's
Give
crazy.
me my sword.
So here's the thing. You always have to know your audience. You always have to know who you're talking to. So that way you can correctly use terminology. Terminology changes depending on who your audience is and depending on what the situation is. And I'm a big believer in, first you learn the technical definition. You learn from an academic standpoint
Webster's.
how something works. What was that?
I said Webster's.
Webster's, exactly. And then after that, once you understand that, because a lot of people you talk to, that's as far as they get, the academic discussion. And when you're talking with people that in this business are going to be lending you money, that are going to be partnering with you, that are going to be selling stuff, going to be buying stuff from you, a lot of times they talk in academic terms. So you have to understand that first. Then once you understand that, then we can have the discussion around, well, there's nuances.
Yes.
And I think that's what happened with this term asset. So let's start with the academic definition of asset. An asset is basically anything that can be traded for a currency or something else that's worth money.
Mhm.
So we can talk about our home. Our home is an asset. I can sell my house and turn it into cash and then take that cash and buy gold, or I can buy a car, or I can buy a rental property. I can buy something else that's worth something that's an asset. Now, a lot of people say, well, your house isn't really an asset because you have a mortgage on it. So you owe money on it. That's true. The mortgage, the thing that I owe money on, that's a liability. That's something that takes money out of my pocket every month, and I can't trade it for something else of value. Here's a good way that I like to think about it. Go up to your best friend and say, hey, let me borrow $1,000. And they say, whoa, $1,000? What collateral are you going to give me? What are you going to give me that I can keep if you don't pay me back? And then you say to them, I'm going to give you X. If they say, yeah, I'll take X as collateral, that's an asset. If I go up to my best friend and say, I want to borrow $1,000, I'll put my house up as collateral. You get my house if I don't pay you back. They're going to say absolutely. If they say absolutely, that's an asset. Now, if I went up to my best friend and said, I'm going to give you my mortgage, I'm going to make you pay my mortgage, they're going to say, no, I don't want your mortgage. That's a liability. If I offer to collateralize my car, I say, I'll give you my car if I don't pay that back. Well, they're going to say, absolutely. I'll take your car, or I'll take some gold, or I'll take that nice painting you have on the wall. I'll take your computer. I'll take your whatever. If they're willing to take that as collateral, that's an asset. If they're not willing to take it, again, like a mortgage or like a car payment or car note, that's something that's a liability. So
for me, I think like the whole misnomer is, I think people are looking at it from the middle class perspective, where a high level investor sees an asset that's something that's actually driving cash flow. So, I think Rich Dad brought it up years and years ago. He tried to make it controversial because the middle class was taught that your home is an asset, buy it, and then you're going to make money off of that. Where in reality, we know it is an asset, but you're not buying a home for appreciation, especially where we are in the cycle right now. You're buying it more for a lifestyle, because any principal pay down you have and any appreciation you may have, you got to pay the hot water heater, you have air conditioning, whatever that is. So I think that's where you have to start out with, at least understand the definition and then see how it applies to your life. Correct?
Right. So that's the next piece. That's the assigning judgment. So when I talk about an asset from an academic standpoint, there's no judgment. So technically, a house is an asset. A bank will take your houses as collateral. Your car is an asset. Your stereo is an asset. This cell phone right here is an asset. I can trade that right now for money. Now, when we get into the judgment part, is that an asset I should be buying? Is that a smart asset to buy? That's a completely different question. So should I be buying my house? That's a completely different question of, is my house an asset? Yes, my house is an asset. Is that the right asset for me at this point in my life right now? Maybe, maybe not. And that, again, is the judgment piece. And that's where we start to get into more opinion, less fact.
Yes.
So should you be buying your own personal residence? Maybe. Should I be buying my own personal residence? Maybe. Should somebody else? Maybe. And that's where we have to ask a whole lot more questions to decide, is that the best asset for you to be spending your money on? Or should you be taking your money and buying a different asset? A car is an asset, but it's not necessarily a smart asset to buy. Buying a $200,000 car that when you drive it off the lot, it's only worth $50,000. A lot of people would say that's not a smart asset to buy. It's still an asset, but it's not the right asset for most people right now. If you've got $10 million in the bank, well, maybe it's not that bad of an asset purchase. If it makes you really happy, if it makes your wife or your husband happy, then maybe it's an okay asset. But again, it's that judgment that we have to look at separately. And that's when we have to ask ourselves, what assets should we be buying today to meet our goals? And that's when you can decide, well, should I be buying a personal residence or should I be renting? Should I be buying an expensive car or should I be leasing or buying a cheap car that's paid off? And that's where we get into what is the right asset for us today.
Gino, we got a couple things here I just want to point out. We need to understand also, are we looking at Webster's or are we looking at the Urban Dictionary? We got to understand that first because there's a lot of variations these days in definitions. So that's one thing.
If I go up to my banker and I say, my house isn't an asset, my banker's going to lose a lot of respect for me because they look at it from an academic standpoint. I'm going to look like an idiot. I'm going to hurt that relationship. So I need to understand that from my banker's perspective, what the definition of an asset is so I can have that discussion. If I go to lunch with you guys and we start talking about, should I buy a personal residence as an asset? Well, we can have a whole different discussion because it's a different relationship.
We're going to have a Mr. Wonderful discussion because even with that guy, we're going back to Mr. When he talks stocks, what's he looking for? He's looking for dividends. He's looking for that to pay. We want something that's putting money in our pocket. That's more of an investor mentality. And on a personal standpoint, I look for artifacts too. I like the term artifacts. Does it have some kind of intrinsic value to you as well? And then going back to the house discussion, there's multiple ways to look at this because my last house that I had, I bought it. It appreciated. I put a little bit of money into it, little tweaks here, so it went up in value, and I was able to sell it for more. The house that I'm currently in is more of a toy. I fix things. There's high finishes on it. If I tried to sell it now, I'd be lucky to break even. Maybe I do, maybe I don't. But it's more of a personal reward type of thing. It's more of a luxury. So there's also different ways to look at homes in terms of, hey, do you want it for a residence? You'll do little nice touches to it so you can then sell it for more someday. Or are you stupid like me and you just enjoy like the finer things and you know you're not going to really recoup or make money on that. So there's multiple ways to look at this stuff.
Yeah,
that's really painful.
It's painful. You know, it's painful. It hurts.
But it's all relative. I mean, if you were going to go to the store and buy yourself some ice cream for dessert tonight, there are a lot of people who would say, yeah, it's not the healthiest choice. That's not a smart choice to be making. But nobody's going to tell you don't buy the ice cream.
It's just a lot cheaper.
Right. And exactly. A house is the same thing. It's just many thousands of times more expensive. But again, that's the relative thing. If Bill Gates goes out and buys $1 million house, that's a lot different than if I go out and buy $1 million house. My friends might say, that's an extravagant purchase. If Bill Gates does it, they're going to say, wow, why are you buying something? Why are you being so frugal? So we have to realize that when we have these discussions, it's very subjective, and saying something like you shouldn't buy a personal residence, you should rent. You always have to qualify that with who is the you in that statement, because if the you is everybody, it probably doesn't apply, but it certainly applies to some people.
And I'm not going to sit here and tell people what to do either. So that's
exactly.
You could even go like off on a philosophical trail right now, which we don't need to, but that's just me.
Well, Jay, the important thing that I've gotten, you've given us so many golden nuggets here. The first one is, I want to ask you, what really makes an investor deadly or lethal or really, really great investor? The first thing is asking those questions. The better questions you ask, the better answers you're going to get, right? Looking deep within. A lot of us don't want to do that internal work. It's hard to look at ourselves and to ask us what our goals are, where we want to be 3 years from now, what we really like to do, what time and what treasure we have, and is it the right thing for me, right? Knowing that. What makes you a successful investor?
I'd say there are a lot of things. So one, and this is in no particular order, but one, knowing your numbers. Because investing really is, I know some successful investors that kind of shoot from the hip. They go with their gut and they say, this seems like a good investment, I'm going to do it. One of two things is true. If they've been successful, they've either gotten lucky or they've kind of built up that gut based on some knowledge that they can't put into words. I know a lot of investors who say they go with their gut, but I know behind the scenes, they've run the numbers in the past and their gut is responding to their kind of subconscious knowledge of the quality of that investment. Then I know other people are just kind of like, they never learn the numbers and they just say, I'm going with my gut, which means I'm guessing. And if they've been successful in the past, it's purely luck. At some point that's going to fail them. So at some point you have to learn the numbers because that's what investing is. Number two, I'm really clear. And this is something that I think is overlooked by a lot of investors. And this might be the most important thing for any potential investor or wannabe investor to do, know your goals. There are so many people that I go up to and we'll start having a conversation. Should I be flipping houses? Should I be doing rentals? And they'll ask me, what should I be doing? And I'll say, well, what are your goals? And they'll just look at me and they'll like, I haven't quite figured that out, but just tell me if I should be flipping houses or lending or doing rentals. And my response is, until you know what your goals are, there's no way. I mean, it's like somebody saying, give me directions to get where I'm going. And I say, well, where are you going? I haven't figured out where I'm going. Obviously, I can't tell you directions to where you're going if you don't know where you're going. And it's the same way with investing. You have to start with your goals. And it's a tough question because a lot of times the answer is, well, my goal is to get rich. Well, that's not specific enough. Why do you want to get rich? And what is your definition of rich? I know some people, my definition of
or
rich
how
is,
do you want to get rich?
Or how do you want to get rich?
Yeah.
Exactly. And how long are you willing to spend getting rich? And how much work are you willing to do? I mean, if your goal is to get rich overnight and not do any work and not have to put any money in, well, I can tell you that's an unrealistic goal. So let's sit down.
I was going to ask you to tell me how to do that.
Shit. You can write a book on that too, you know?
Play the lottery and cross your fingers.
Oh, I was hoping you weren't going to say that. Okay.
So the first thing is setting goals. And you just brought up a really good point, which is one of the best reasons to set goals is to sit down with somebody else to have them help you realize if that goal is reasonable or not. Because again, a lot of people have that goal of, I want to make $1 million in the next year, but I only have about 2 hours a week and I don't really have any money. And if you start with that goal, that's great, but let's have a discussion and I'll explain to you why that goal is unrealistic. And then let's figure out some realistic goals. And once you have the realistic goals, then we can sit down and figure out what are the directions to get there? What are the right vehicles and the right paths and the right strategies and the right tactics to get to where you want to go? But you have to start with figuring out where you're going, and it has to be realistic.
So I like that a lot. I think the other thing with goals, everybody, don't so focus on making the $1 million. Focus on the person you need to become to get the $1 million. We forget about the processes and the systems that James Clear says you need to fall in love with. We only focus on the $1 million. And I'm going to tell you, after you make the $1 million, what's next? You know what I'm saying? So focus on the person you need to become, the hard work you need to put into, the education you need to go through, the punches in the gut you're going to get. Like Mike Tyson says, you got to plan until you get punched in the face, and you're going to get punched in the face repeatedly with investing. So don't only focus on the goal. So everybody, write that down. Know your numbers. Fall in love with the numbers. Don't fall in love with the deal. Remember that. Know your numbers and know your goals.
Gino, I want to piggyback on something Jay said early. And the interesting thing is, for us, we do the same thing over and over. You know, it's basically mom and pop acquisitions through multifamily. So you need to know your numbers on the front end, but there can be an intuition that happens over time where I might go into a deal, know the purchase price, and know probably within 10 minutes of walking the deal, hey, this is going to work or not. But that's because we've done the work on the front end, and we're still going to do our budgets. We're still going to do our due diligence regardless, but you can start to analyze these quicker once you've done it 1 million times. So it does get easier as you go.
And it's important you say that, Jay, because we just looked at a deal about a month ago and it looked okay. 90 offers, 13 at asking. We're about $10,000 short of what the number was. We know this is a 1970s asset that's going to need at least $10,000 per door in CapEx. You're going to need new roofs. You're going to need new decks. You need a ton of work. So for us, it didn't work right after
and
spending
more
10
skilled
minutes.
labor than a newer build. That's the other thing that I don't think people take into consideration. These older assets required higher skilled techs on the properties most of the time, or you're going to be subbing stuff out, which is going to snowball on you as well. So there's,
Yeah, so it's important. It's important you say that. This question's from. Go ahead, Jay. I'm sorry.
I just want to throw out real quick because you hit another important one, and I was listing off like you had asked, why have I been successful, and other people have been successful, and I think I have been successful, and that doesn't mean there are a ton of people that have been much more successful than I have been, but there are certain traits and qualities that I see in all of these people, and so we talked about. They're really good at setting their goals, number one. Number two, they're really good about knowing their numbers. And then you guys just touched on number three, which I think is super important, is the discipline piece. So you can know your goals, you can know your numbers, and then you can still do a bad deal because you're desperate or because you're lazy
pencil
or
whipping, forcing it. Yep.
Yeah. So discipline and being able to say no. I mean, the best deals I've ever done are the ones I've said no to. And I know that's cliche, but it's really true. I look back and there's so many deals that I was like, oh, I want to do this because I don't have anything else to do, or because it's something new that I've been excited about doing. And I look back and I'm like, I'm so glad I didn't do that because the numbers didn't work out. It didn't meet my goals. My gut told me it was wrong. And so I'm glad I didn't do it. Too many people will move forward with a deal like that and then look back and say, oh, that one deal destroyed everything.
If you ever, and I'm going to say something sexist here because I think it's sexist and I just don't know where I'm operating these days. But here's the deal. Like if you ever dated a hot chick and then she turned out to be a psycho, but you went for her because she was a hot chick, that's what Jay's talking about right now.
That's exactly what I'm talking about.
And vice versa.
Like, yeah. And then the, it could be a guy, a hot guy. And then he went psycho, whatever the case may be, trying to keep everyone happy in this world these days. Right. But whatever the case may be, you went for it because it was like fun, exciting. I had nothing better to do. And then it dragged you down and then they threw a rock through your windshield. Look, I've never had these things. I've been with my wife for a very long time. But I'm just saying, I watch TV.
Stereotypes on both sides. The hot girl that goes psycho, or the hot guy that cheats on you.
Yeah.
Wow. I don't even know. Jake, you can take over the rest of this conversation because I'm talking about investing. You guys are talking about the property damage here. So
yeah, you know how it goes.
What I love about this question, Mikey T wanted to ask this question. When do you know it's time to diversify, to get into another investment? Because Jake and I, we've really been down multifamily. The great thing about what we're doing and what you're doing is we're multifaceted multifamily. Let me hold up the honeybee here because it's what you're doing. You're creating businesses within businesses, right? We've got the property management. We've got the education. We've got the syndication. We've got the capital company doing mortgages. So we've got so many different facets within our business, but we've never gone out and said, hey, you know what? Time for cryptocurrency, or you know what? Time for, fixing and flipping homes. When did you know it was right for you to say, you know what? I'm going to get out of my lane because I've dominated my lane and I'm going to, go into another asset class or invest into another asset class?
This goes back to what I was talking about earlier, which every person is different. I mean, you look at Warren Buffett. Warren Buffett has been investing for 70 years now, 60 years, 70 years. And basically he's done he's done the same thing that entire time. He just does the same thing over and over and over, and it works. And he's made tens of billions of dollars doing it. Then you look at guys like Elon Musk. Elon Musk started with PayPal and now he's flying to the moon. And he can't sit still and do one thing. He's got to branch out. And so there's no one right path. If something's working and you're enjoying it and you're not getting tired of it, keep doing it. Absolutely. But if you're the type of person, and I'm certainly this type of person, that I get bored of things quickly and I have to move on. But here's what I'll say. For people like me that get bored and need to move on, don't move on before you've mastered something. You need to be willing to commit to something long enough to get so good at it that you can always come back to it. I like to say that I have one or two things that I do that I can always fall back on. I can go try and do something new, and if it doesn't work, I can come back to what works. And I can do that until I've rebuilt my capital, or I've rebuilt my ego, or I've rebuilt my confidence if something has caused me to fail. I always have that fallback. And so the way I look at the things I do is I did flipping for a long time before I moved into rentals. And I didn't move into rentals until I really felt like I had mastered flipping. So I knew I always had that to fall back on. And then once I really felt like I understood rentals, I started moving into lending. And then I started moving into multifamily, small and mid-sized multifamily. And then I started moving into other things outside of real estate. Like you mentioned earlier, I've done a lot of crypto investing, and I've spent a lot of time really understanding that industry, understanding the technology. I moved into owning racehorses. And let me tell you something, that's something that I really love doing. I'm never going to get rich owning racehorses. Nobody does. But I was comfortable moving into that because I now have multiple other niches that I can fall back on because I've quote unquote mastered them. So for anybody that gets bored like I do, nothing wrong with that. Nothing wrong with moving on. Just make sure you're not giving up or moving on just because you've gotten bored. Because this goes back to the discipline thing. Too many people, they'll get 50% of the way there and say, okay, now the hard work's coming. I'm going to move on to something else because this isn't working. No, it's working. You're just lazy. And don't be lazy. Get to 80%, get to 90, 95% so that you always have that skill to fall back on, then move to the next skill, and then move to the next skill, and then move to the next skill. And nothing wrong with moving on. If you're the type of person that can't just do one thing, just make sure you're not being lazy and undisciplined and moving on before you've really mastered something.
Quick rabbit trail. Does the insurance in horse racing allow you to limit your downside risk?
Um, Yes, it's just like houses. So you can lose if you flip 100 houses, you can lose $2,000 per house, and that's a lot of money. Or you can make $1,000 per house and then lose $300,000 on one. And certainly the insurance mitigates the risk. But when you're doing high volume, just like in with houses, a lot of times it makes more sense to self-insure. And so we've owned a lot of horses. Sadly, we had our first horse pass away a couple months ago, and the insurance ran out the week
Is that
before.
because you got upset and you shot it, Jay, or was this like
No,
something natural?
it was so sad. No. She had a heart defect, and we didn't realize it. And she was like my little baby. It was so sad. The
So
insurance
is that
ran
on the
out.
doctor? Was the physical not there? Or are we looking at
No,
saying, hey, we
this-
got to get a better
this-
underwriter here?
No, this was something that, because we did have insurance on her.
Yeah.
She was a very successful horse. She was a high priced horse. And even with the underwriting and the physical and the test, they didn't catch it. So it's one of those things that really couldn't have been
Due diligence, baby.
Due
Yeah.
diligence.
You
Absolutely.
got to make sure that plumbing's tight.
Yep. And so it's risky. And again, it's just like houses. I mean, with houses, you're buying 6-figure assets. Horses are often 6 or 7-figure assets. And so you have to understand the risks. And that's another thing. So this
Are they leveraged as well? I'm sorry, we're going down a rabbit trail, but I'm just curious. You leveraging the horses or are you cash?
We're not, although some of them we're syndicating.
Yeah.
Very much like
investors,
multifamily
yes.
syndications,
Yes.
where we'll go in, we're operating, we're making the decisions, we're buying the horses, and then we're going out and we're finding passive investors, limited partners who are bringing money in, and they're kind of funding half the deal. So we'll fund half the deal, they'll fund half the deal, but we're making all the decisions and we're just paying them a percentage of the returns. So it's funny, horse racing is a lot like houses. There are a lot of strategies and niches that are very similar. You can do the cash flow thing where you buy a horse, you race it once a month, it wins or comes in second or third, and you're making more cash than it cost you to hold the horse. You can hold a horse for years. You can also do the flipping thing with horses. You can buy a horse that you look at, you think this horse just hasn't been trained well. This horse has a lot of progress that can be made if you train it well and you give it the right caring and love. You buy that horse, you make it a much better horse. He wins a couple races, and now you can sell that horse for 10 times what you bought it for. That's just like flipping. You can even do the new construction thing where you buy a horse and you breed the horse, and now you have baby horses, and you can either hold those horses for cash flow, just like building new construction that you hold as rentals, or you can then sell those, just like building new construction and selling it off. So there are a lot of similarities in the horse race business as there is in houses. Horses are just another asset. That said, I'm an animal lover, so it's hard for me to treat the horses just as assets.
But Jay, be honest. The best place to raise money is at the track. Come on, that's what you're in this for, right? Come on, it's gotta be, right?
If you want to raise small amounts of money, yes, the track is a great place. So a lot of people that will throw their money at anything.
So it's amazing. It's a value add, right? I mean, I never thought of a horse as a value add. You just raise the value of the horse by just making a tweak. You're raising the rents, you're getting the NOI up, and that's basically the
Get Michael Jordan's trainer on it, you'd be fine, right? The relentless guy.
You analyze a horse very similar to the way you analyze a house. So there is an NOI, there is a cap rate, and based on the amount of money that horse can earn you in a given month or a given year is going to define what it's worth to somebody else to buy that horse. So yeah, you increase the NOI by decreasing the expenses, by getting it healthier, or by increasing the income, by getting it to race better, and suddenly your horse is worth more.
Wow. I forgot my next question. We're talking about horses. We're talking about guys throwing rocks.
Right there,
What's going on? No, I mean, it really is. It's amazing. The fourth one I wanted to mention, understanding risks. That was another thing with investors. Limit your downside risk. We mentioned know your numbers. Number one, everybody write that down. Know your goals. Number two. Number three is discipline. No pencil whipping. Do not get theiritis. That's number three, really important. And number four is understand your risks. And what I want to say about that story that Jay just told us, the average person would probably quit after their horse passed away or something happened. He's not going to quit. He's going to learn from that problem and make it an opportunity. I think that's another thing that investors can look at. They can look at their mistakes and turn them into opportunities and say, these are learning lessons. What can I do better next time? So Great story.
I hate the fact that you guys keep saying these before I get to them. I was going to say risk next, but you beat me to it again.
Sorry about that. Well, you're telling me these stories.
Risk.
Gino's in homeschool mode. He can't help it.
No, it's great. And you're absolutely right. So risk would be the number 4 thing on that list that I would say all great investors share, this ability to analyze and to mitigate risk. And it's not to say that every investor has to have the same level of risk tolerance. I know a lot of investors that have really high risk tolerance. They'll leverage 100% on a deal. They'll go in on a 7 or 8 figure flip. They'll buy a whole bunch of properties knowing that the market could turn, but they think they're getting great deals. And then I know other investors who they only like to buy for cash. They don't like any debt. They buy one property at a time. They do small flips and they're happy to make a few $1,000s. So they're not taking a lot of risk. And there's nothing wrong with either of those. There's no right or wrong answer there. I look at my wife and myself, and we invest together. We own everything together. She is much less conservative than I am. She's the one that's saying, "Oh, let's go give this a try. What's the worst that's going to happen?" And I'm the one that's saying, "Well, the worst that could happen is we could lose money, and then I'm not going to sleep well." And so we have this tension between us for risk. And the way we often resolve it is that we sit down and we actually analyze the risk. We say, okay, what's the likelihood of X happening, and what happens? How much money do we make or lose if X happens? What's the likelihood of Y happening, and how much money do we make or lose if Y happens? How about Z or A, B, C? And we list all these things out, and you can actually do a quantitative analysis, a risk analysis. It's called an expected value equation. And I'm not going to go into the details here, but you can literally list out each of the possible outcomes, how much money you would lose or make with each outcome, and the likelihood of each of those outcomes happening. You can do a little bit of multiplication there, and you can get a number which is called your expected value. And that's how much money you expect to make or lose given the likelihood of each of these scenarios and the result for each of these scenarios. And so I will actually take my best guess at all those numbers, do that calculation, and say, yeah, this deal should theoretically make money. And then the second thing I'll do is I'll say, what's the worst case scenario in the deal? So what's the worst thing that could happen? And then I'll say, if that happens, how does that affect me? How does that affect my life? How does that affect my relationships? How does that affect my psychological well-being? And what could I do to mitigate if that absolute worst case situation happens? And between those two numbers, the most likely result and the absolute worst possible result, I'll look at those two things and say, is this a deal I should do? And I might come to a different conclusion than my wife, who has a higher risk tolerance. I might come to a different conclusion than somebody who has a much lower risk tolerance, but I come to a conclusion that works for me. And everybody needs to do that on their deals. They need to really understand their comfort with risk and understand what's the worst case and the most likely case for any particular deal that they're going to do.
Think about what you said earlier. You're setting up a lifestyle by design in real estate to reach your goals. And you're saying, well, if something's going to keep me up at night, that's not in alignment with where I want to be. So that holistic approach is going to prevent me from doing that deal that may keep me up at night. I think that's very important for everyone to hear, because just because it may be a good deal or something, but if it's going to drag you down in other areas of your life, you want to take a holistic approach if your goal is this, lifestyle by design like Jay's looking at here. So I think that's very important for people to hear.
Yeah. When I was in my mid-20s, I could afford to take a whole lot more risk, because if I lost everything, if I went $1 million into debt, well, I have 50 years to dig out of that hole and rebuild. Now that I'm in my late 20s, no, I'm just kidding. I'm actually in my late 40s. I don't have that same runway that I had. If I lose everything today, I don't have as much time to rebuild. Also, I have a family now. I have 2 kids, so the risks are higher for me. So I don't have the same risk tolerance I had when I was 25 years old. And so all those things have to factor into everybody's potential situation, because everybody's going to be in a different situation, and there's no one size fits all with any aspect of investing, and risk is one of those aspects.
Last question before I go to the personal growth. I want your take on when you get into a thing, looking at mentors, paying for education. Because for me, when I first started out back in 2008, I didn't know which way I was going. I got into a mobile home park. I did bad. Got into a strip mall. Did bad. I finally said multifamily, and I invested. I say invested now, but back then I spent on my education, became a certified life coach, spent money on that. And for me, it was life changing because I had systems. It dramatically shortened my learning curve. Was it a lot of money? Absolutely. But on one deal, I paid that back and then some. And just the ability to have that comfort to be able to call that coach and say, hey, what do I do here? What do I do there? I know a lot of people frown upon that, but for me, it was life changing. And I mean, even now, last 18 months, 2 years, Jake and I have probably spent over 300 grand on coaches, mentors, because we're scaling a business. I've never done that before. Why do I have to reinvent the wheel when I have other people out there doing it? So I just wanted to get your take on it.
Yeah, I like to start from the other side. And I like to ask the question, why do people that pay for mentoring or coaching, why do some of them fail? And when you understand why some people fail, you'll know if it's right for you. If you fall into one of those groups where people tend to fail, then it's probably not right for you. If you don't fall into one of those groups, it probably is. And so here's the first one. I see too many people fail because they jump into an area, a niche or a strategy, and they find a mentor and they hadn't really thought through if that's something they want to do. I know people that have spent $50,000 to learn to flip houses, and then they get 2 weeks in and they realize, I don't really want to flip houses.
Yes.
And or they'll spend money to learn multifamily or to learn notes or to learn whatever it is, and then they get in and they realize, I'm not really excited about this. This isn't going to help me reach my goals. I don't feel like doing this. They've now thrown their money away. So the first thing I would say is, if you don't yet know that you're not really passionate and ready to do something, you're probably not ready to hire somebody. So that's number one. Number two, you need to find somebody that has gotten to where you want to be, or that at least has helped other people get to where you want to be. Michael Jordan had a basketball coach. Tiger Woods had
Tim Grover. We were talking. That's what I was referencing earlier. Yeah, right. It's Tim Grover, right?
Yeah. So Tiger Woods has a golf coach. That golf coach has never been the number one golfer in the world. That's okay, but he's trained other golfers that have been close to the number one in the world. So you need to find somebody that either has gotten to where you want to be or that has gotten other people to where you want to be. And too many times we'll go and we'll say, okay, I'm going to find the cheapest coach or the cheapest mentor or the one with the biggest name. No, you need to find somebody that has a proven track record and has either gotten to where you want to be, where you look at them and you say, if I have their success, I'm going to be happy. Or if I have the success of the people that they've already trained, I'm going to be happy. That's the right mentor. So picking the wrong mentor is the next thing. And then the other thing is finding a mentor that's in it for the wrong reasons. There are a lot of people out there that I see that are mentoring, that are coaching, but that aren't doing their own deals. And anybody that's out there mentoring and coaching, but are no longer doing deals, that's a red flag to me. Because I don't do much coaching. I don't do much mentoring because I don't have the time. But the day I become a coach or a mentor to replace doing real estate is the day I'm going to say, I'm not doing this for the right reasons anymore. So make sure that you really want to be doing whatever it is you're paying for. Make sure your mentor or your coach has the experience and is either where you want to be or has gotten other people to where you want to be, and make sure that your mentor or your coach is in it for the right reasons. And if you can satisfy those three, I am a huge proponent of paying for help.
You know, I just never know what to expect from Jay Scott. I thought this was going to be about cryptocurrency or horses today, and it ends up being the podcast about goals. So with that being said, let's take a quick time out to hear from our sponsor.
Are you looking for ways to improve your life?
Here at Jake and Gino, our mission is to empower students through financial education and the vehicle of multifamily investing.
Yes, Jake. We agree that a person with financial intelligence can change the world for the better.
We've created our proprietary 3-step framework, buy right, manage right, and finance right, that we teach to our community. This framework, along with education, our one-on-one mentorship, on-site boot camps, and the amazing community has propelled our students to massive success.
We've all been there. We've had so many students that have been able to shift their mindset, overcome limiting beliefs, and set a clear path to achieve their goals. Whether you're currently fixing and flipping, wholesaling, or buying single-family rentals, and you know that multifamily investing is the right vehicle for you, I encourage you to visit jakeandgino.com/apply to schedule your complimentary consultation with our team. And I want to let you know this isn't a high-pressure sales call. It's really just a discovery call to get to know each other better and see if we're a good fit for working together. And if for any reason we're not a good fit, our team has tons of resources we will share with you to help you along your journey.
If you're ready to stop spinning your wheels, go to jakeandgino.com/apply and schedule your call now. All right, we're back. Really excited to hear your best tip. You said you just did a syndication recently. What was your best tip or learning lesson from that?
So that's easy. I align myself.
What the fuck? That's probably what it was. Like, holy crap.
I aligned myself with a couple people that had done this before, that had a lot of experience, that I really trusted, that I knew we had the same goals. And I basically didn't go in with the attitude, I know everything, I can do this. I went in with the attitude, let me work with you and let me help you and let me learn from you and let me take a back seat. I mean, a lot of people look at me and they say, okay, he's done 50 or $60 million in deals. He's done 400 and some deals over 12 years. And they assume that like I'm always leading my deals. No, I have no problem saying I know nothing about this area. I'm willing to take a back seat and learn and teach me. And I'll volunteer my time and I'll volunteer my efforts and I'll put money in, because sometimes you need to learn from somebody else. And it's not an ego thing for me. I have no problem admitting that when this was a $20 million syndication deal, I have no problem admitting that when we started digging into the numbers, I'm sitting here thinking, wow, there's a whole lot more moving parts than I ever expected. I need help. And so I aligned myself with a team that was really good at this, and I'm learning from them. And so for me, that's the biggest takeaway, is just that never be scared to say, I don't know what the hell I'm doing and I need help and I need to find the right people to help. And it goes back to the coach mentor thing. There's nothing wrong with saying there's other people that know this better than I do. And whether you're paying for them with money or paying with time or paying with effort, nothing wrong with paying to have somebody else help you out.
We're going to say it one more time. You either pay to play or you seek to serve. And what Jake is doing right now, he's doing a little bit of both. He's seeking to serve, right? He's out there, he's helping out as much, but he's also putting skin in the game.
Yep.
So you can do both. I mean, that's a great way. You're learning while you're earning. And a $20 million deal, maybe a $3 or $4 million deal in your first syndication, Jay, 20 million. I mean, that's like, that's sort of stretching it, but that's what we love about you, bro.
And again, great team around you. And so let's talk about number 5 in that list of what great investors do. So we had goals, we had discipline, we had knowing your numbers, we had risk, and number 5 would be building a great team around you. All the successful investors I know have a fantastic, strong, reliable, trustworthy team around them. And so that's another thing I like to do.
That's awesome.
Just out of curiosity, what city was the deal in?
It's in Houston. We close
cool.
on it in 2 weeks.
Oh, so the party's about to start. The real work's going to begin in a minute. Excellent. Excellent.
We just closed our raise yesterday, and we're getting to close now.
That's awesome. Congrats.
What is your best habit for success?
Trusting my wife.
Oh, here we go with the Gino answers.
So it's true. And so substitute their wife. For anybody that's listening, you can substitute the word wife with whoever it is out there that you trust to do the right thing, that cares about you and keeps you accountable. You guys have each other. I imagine you guys, Jake, you probably use Gino to keep you accountable. Gino, you use Jake to keep you accountable. You probably both use your wives. But for me, having somebody there that won't let me do anything really stupid, or at least will question me before I do something really stupid and open my eyes to the fact that I'm about to do something really stupid. That's been a huge key to my success, because I know that as long as my wife is working with me, it's like it's having 2 of me, or I guess you would say it's like having 2 of her. It's a lot easier. It's a lot more difficult to make a big mistake when there are 2 people that have their eyes on every deal.
For sure. Any books you've read in the last year that you'd like to recommend?
Oh, let's see. I'm looking at my bookshelf. I've read a lot of good things in the last year. Anti-Fragile was a great book. Let's see.
Tell me why.
It's all about risk. And we've talked a lot about risk today, and it's basically a 300-page tome on managing risk in your business. And it's tremendously, it'll get you to think about business and investing completely differently than anything you've ever read.
So Jay, I thought you were going to talk about being woke and not having those safe spaces, not being fragile, being the opposite of that. So I'm like, you need that to be an investor, because if you're not worried about getting punched in the face and worried about being right and all that, then you're not made to be an investor, right? So
100%. No, this book is all about it's by Nassim Taleb. It's all about risk and risk management.
Okay.
What else? I'm looking at my bookshelf. Just started Traction, which I know a lot of people have read. I'm loving it so far. What else is on my bookshelf?
Once you get through Traction, do Scaling Up if you haven't read that one yet.
It's on my list.
Yeah.
And then I reread a book that I try and read at least once every year or two called The Goal. And it is all about, and this is probably my favorite book that too many people don't know about. I mean, it's a best-selling book, but for some reason, most people I talk to don't know about. It's called The Goal, and it's all about systems and processes and clearing the biggest roadblocks in your business to allow you to scale quickly. And it's probably my favorite business book out there that most people have never heard of.
I'll write that down.
In the process of doing that in some areas right now. What's the best way for folks to get a hold of you?
Yep. So my website's jscott.com, just the letter J, scott.com, 123flip.com. Please listen to our podcast. My wife and I host the BiggerPockets Business Podcast, where we talk about entrepreneurship, owning businesses. We talk with our guests are everything from like mom and pop business owners that just started 2 months ago up to, we've had Barbara Corcoran on the show. We've had Jay Papazan on the show. Last week we had the editor-in-chief of Entrepreneur Magazine. So kind of the whole gamut. So please listen to that. And if anybody wants to reach out to me personally, my email is j@jscott.com. You're welcome to just send me an email.
So today is September 1st, the day where we are recording this. We're closing out 2020. Give me something badass that you're going to do to close out the year.
We're doing a $20 million syndication. We've done more deals, and we haven't talked about the economy in this, which is probably good because that's another hour discussion. But a few months ago, I was thinking I'm not going to do any deals for a while. We did more deals in August. I think besides the syndication, I think we bought something like 17 or 18 houses and pieces of land.
These are flips mostly, or?
No, it's actually a lot of rentals.
Oh, cool. Okay, gotcha.
The
mini Blackstone, Jay Scott.
It's been crazy. This is more deals than we've done in a month ever, at a time when I really thought I was going to be taking a break for a while. So yeah, the big things to round out the year are just buying more rentals and building up the cash flow, and doing the syndication deal. Very
nice. G-Father, take us home.
So Jake, it's 2008. Jay Scott's in the middle of the midlife crisis. He says to his wife, "I hate this corporate America, driving around, flying around 70 hours a week. Let's just move and let's just hang out. Let's just do a flip. See what a flip looks like, right?"
You know, fast forward 12, we can do it.
The HGTV, the fast forward 12 years later, he's got over $50 million. He's raced horses. He's got cryptocurrency. But the most important thing is he's learned these 5 principles, and I want to share them with everybody one more time because they're really important. Number 1 is really know your numbers. It's really important not to pencil up a deal. Know the numbers, right? Number 2 is to know yourself, know your goals, know what you want out of life, not what Jay Scott wants or what Jake and Gino wants or what my wife walking up the steps wants. What do you want? That's really important. Become crystal clear. The word is clarity. Become clear. Number 3, have the discipline. It's hard work. But anything that is worth it in life is worth working for. So become disciplined and work hard. Number 4, understand the risks. What risks are involved in doing those deals? Number 5 is building a team. Having an amazing team around you is going to be great. Don't be the IMA guys like Jake and Gino, those 2 morons out there cutting trees and doing stuff all by themselves. It's great in the
Unless
beginning,
you enjoy it, right?
But you'll never scale up. You'll never get there. And I think 5.1, I just put this little acronym out there, ROE, return on effort. As you get older and you start looking at stuff, is it worth owning a D property, 60 units where you're putting all that work in there and there's so much effort and it's hard to do the tenants, where you can buy something with a little less work, maybe a little less return, but there's a lot less effort. So I think we have to balance all of those out. Anything you want to add?
That's the
Jake?
goal book. No, that's the goal book that he mentioned right there. If it's going to be a soul suck and it's going to pull away from other areas of your life, that may not be aligned with your goals and where you want to be in creating that life for yourself. So I think that was one of the biggest takeaways from the show. Mm-hmm. And it's something that folks ignore at times because it may make money, but how much of a time or soul suck is it going to be on your life?
And I think the next 3 months, we got to have Jay back on to talk about the syndication, talk about how it went. And I want to get into cryptocurrency. I definitely want to get into crypto a little bit.
Poor Gino didn't get any love today.
I know Jake doesn't want to get into it, but I still want to talk about Ripple. I still want to talk about where crypto's going, and even the economy. We should talk about, the economy a little bit and how we have the haves and the have-nots, right? Because right now, I always say people with financial intelligence can change the world for the better. If you're financially intelligent, if you know what an asset is and you know what a liability is and you know how to invest your money, you taking control of it, you'll be able to lead a much more empowering life. So I want people out there really think that, really learn the financial vocabulary and learn how to start investing your own money. It's what Mr. Wonderful said, right? Is your money working hard, or is your money working hard for you, or are you working hard for your money? That's what it comes down to. And you have to work hard for your money in the beginning. I get that. But then after that, have the mind shift, the abundance mind shift, where let your money work hard for you. And all these principles we've been discussing today will allow you to do that.
Jay, you're going to say something, and then we just got Gavin and cut you off.
No, it's okay. Like once again, you guys kind of said something that I was thinking that I hadn't yet said yet. Gino just said, basically, if you do the first 5 things that we talked about, if you are really good at implementing those 5 things, then you also get number 6, which is you get the ability to choose the things you enjoy doing.
Mm-hmm.
If you're really good, I mean, not all of us have the ability to do what we love doing, but if you want to do what you love doing, if you can do those first 5 things really, really well, you've got the discipline, you know your goals, you know your numbers, all those things, then you're going to have the ability to choose what you're doing, because if you can implement those 5 things, you can make most things successful.
And the more action you take and the more experience you get, you're also going to figure out what you hate and you don't want to do it. You can cross that shit off the list. So.
Exactly.
My boy's, I know what you're thinking. Bookkeeping off the list, bro. No bookkeeping, counting, gone, right? I can see that, right? Love that.
Guys, really good time today. Jay, thank you so much.
Absolutely.
Thanks, Jay.
Great. Thanks, guys.